I'm calling today's session the building the portfolio. And like I said, I've never done this talk before, so it's brand new. So you're gonna have to bear with me. But I did write it. In fact, I wrote it over the last couple of weeks, and this is the first of two. A little bit of background on me. So I spent 20 years, the first 20 years of my career out of college as a market maker on the SIBO. When I got out of school, I don't even think I knew what options were or what trading was, but I figured it out pretty quickly. And from the early 80s, like 1981, all the way till 1999, 2000, I was a market maker on the floor of the Chicago Board Options Exchange. I traded primarily in the S&P 100, which back then was called the OEX. At the time, it was the largest S&P pit. Now the S&P 500 is, obviously. But at the time, the S&P 100 was the largest pit. It was about 400 or 500 people in a very small area. And I was there from pretty much from day one. So great experience and amazing, kind of the last frontier of like I like to say, last frontier of hardcore capitalism back in the 80s and 90s. In 1999, towards the end of that dot-com boom, I built a company called Thinkorswim with my partner, Scott Sheridan. Scott and I traded together on the floor. We had built a prop trading firm. We decided to roll the dice and build Thinkorswim because we had been down there almost 20 years, and which turned out to be an amazing platform. We were a public company. We were bought out by TD Ameritrade in 2009. In 2011, I started Tasty Trade, which was the digital financial network, in which we now call Tasty Live. And we started another brokerage firm, which we did call Tasty Works, but it's now called Tasty Trade in 2016. And it's now the largest boutique options and derivatives firm in the world. So, and we have pretty much a global presence now. So it's been an amazing, couple of decades, and I've been in this business my entire career. And that's kind of, the only reason I tell you that is because I think it's important to have some credibility, and it's important to at least, have some validation. I'm not here. I don't sell anything. I really just want people, eventually to, if they can, to use our brokerage. But more important than that, our model is a goodwill model. We basically tell people everything we know, and the goal is to change the world of finance. We've done a pretty good job of it so far, but there's still a lot left to do, and we've got to pass the torch down the road to somebody else, and that's going to be the fun part. So today is the first part of building a portfolio. It's Wednesday. It's 11 o'clock Central Time, just a couple minutes after, and it's Feb 28th. Part two, which I've already started to write, but I have not finished yet. That's how new this content is called Managing the Portfolio. And that is going to be the heavier of the two pieces, will be part two. But believe me, there's plenty of stuff here in part one. Part two will be a month from now, March 27th. And again, at 11 o'clock in the morning. It's just for 1 hour. I do these two webinars so that I will set up for the live events that we'll be doing over the course of the year. Where, like I said, we'll be in 8 different cities. You can sign up at tastylive.com/events, tastylive.com/events. And you can sign up for any one of the live events. Everything we do is free. And both of these sessions, today's session will be available to you in about a week. At the tastylive.com/events at the bottom of the page, just scroll down and you'll be able to get to listen to a repeat of it, and also to get all the slides from today's show. And for part two, the same thing. You'll be able to have all the slides from that. When we do the live event later this year throughout the country, you'll be able to also get eventually get the slides from those events. And so it'll be really helpful in training and for, educational reasons. We like to call it edutainment, but whatever. And on top of that, later this year, we're going to do a digital version of the event as well. So you can have it in a digital collectible, like an NFT fashion. And again, everything we're doing is free. That's the nice thing about having really good partners with the Chicago Board Options Exchange and the Chicago Mercantile Exchange. We're all Chicago based, so we support each other. And I think it's a great thing that they've, both those exchanges have stepped up because these events are crazy expensive now, and they're helping with the cost, so it's awesome. Anyway, so a month from now, you can sign up for the part 2. Again, tastylive.com/events for everything. Okay, so now I'm going to get into heavy stuff. So like I said, as we like to say, grab a mitt, grab your bat, grab a ball, get a helmet on, because there is going to be a lot of content today in the next couple of 55 or 60 minutes. The key topics that I'm going to cover today are product mix, starting out a little easy with stocks, options, futures, and futures options. Again, the purpose of this, doing it multi-exchange, and by the way, this is the first multi-exchange content creation kind of ever. This is the first collaboration of option exchanges and futures exchanges. I'm product indifferent, meaning I don't care what you trade, as long as you build a portfolio that's capital efficient. That's why I didn't want to do something this year where we just focused on futures, just focused on stocks, just focused on crypto, or just focused on options or ETFs. I think it's important in 2024 that you build a portfolio and you kind of be indifferent to what the product is, and you're more focused on the capital efficiency of those products. So number 1, product mix. Number 2 today will be all about capital efficiency, and we're going to cover all product classes. And again, today is building the foundation. The next session will be managing the portfolio. The third part today, we will talk about portfolio allocation, allocating that capital. So first we talk about the efficiency, and next we talk about how to allocate the capital. All these topics are based on the number of emails. We get 5,000 to 7,000 customer emails a day. And from those, when we sort them out and we kind of look at, where the majority of questions come, portfolio allocation, capital efficiency, products. And then lastly, we get a lot of questions about how do you build a directional case from a professional side? Like there's obviously the retail side, which is kind of long been about technical analysis and some forms of macro. And there's obviously a macro side as well to this industry and to the world of finance. But there's also a quantitative side, and there's also a subjective side. So today we are going to cover building a directional case, adding a little, objectivity, subjectivity, whatever you want to call it, into building a case, looking at potentially at price, looking at volatility, looking at different quantitative, statistical, and probabilistic ways of looking at a portfolio. And then a month from now, we'll talk about, okay, we've established a portfolio. Now, how do we manage that portfolio? And then to take this thing absolutely full circle, like I said, we will be in 8 different cities, 7 in the US, all Super Bowl cities, and you can find all those cities on tastylive.com/events. And we'll be in all those cities. It's almost a 3-hour show. We use really cool event centers. It will be not like a fun show, but it will be a heavy show. So you'll bring your, thinking cap on those days. But we will have 6 different speakers to keep it interesting. And they're all people that have, that work for us. And they're all people that are on the network. So they're all professional speakers, and they really cover the educational side of this stuff. It's just exceptional, the work that they do. Okay, let's go to the next slide and we'll take you through this. So again, thank you everybody for coming on today. If you have any questions, I have a whole group of people. I think Anthony, Brittany, Christian. We have 2 or 3 people from our trade desk in Chicago. We have Brittany on the Tasty side. If you have any questions at all, because I am not going to look at the chat during this talk, so I can focus on the talk. But if you have questions at all and you want to type something into the chat, we have 3 people on during this webinar that can answer your questions, or that can point you in the right direction, whatever it is. If you want to reach out to me, and I am an email junkie, if you want to reach out to me, you can email me at tom@tastylive.com, and I'll try to get back to you, in the next day. tom@tastylive.com if you want to reach out to me. I'm an email junkie. Okay, let's do it. So sit back, relax, and enjoy. I think this is, like I said, first time I've done this talk. I just wrote it. And I think it's a direction that we're going to be going to in the future, with combination of all different products, combination of all different strategies, and a discussion of actually building a portfolio, because active traders are fascinated by building a portfolio. So am I. So we're going to start off with product mix: stocks, futures, and options. And like I said, this will get progressively harder as we finish up today and as we get into, the next discussion. So product diversification. Now, you've heard the term diversification a lot because everybody talks about, diversify this, diversify that. We are going to cover it in a little bit different way. I don't look at diversification as just being in a couple of different stocks. I look at diversification a couple different ways. How are we going to utilize the buying power that we have in our account, and how are we going to distribute that buying power, and what kind of leverage are we looking for? Like, if we were to compare the amount of money we're using to a notional equivalent, if we were comparing the amount of money we're using to buying power reduction, the cool thing about trading in 2024 is that back of the envelope, you can generally use buying power reduction as a very effective mechanism for managing capital versus your net lick, and for managing capital versus your risk. So for starters here, and again, this is not going to look like your typical portfolio. This is a portfolio, building a portfolio for active traders. So this breaks down something somewhat similar to what our breakdown is at our brokerage firm. So at Tasty Trade, just to give you an idea, so I give you a little context around this. Our business breaks down to about just under 80% options, about 10% futures, about 10% futures options, small percent cash, small percent in digital assets. But that's kind of the primary, that's our primary business model. Now, when I look at building a portfolio, I'm fairly similar to that. About 20% of my active portfolio would be considered in equities, underlying stocks. Why would you use stocks in an active trading account when they're not as effective tool for buying power? Well, one, the underlying might not be liquid enough not to use stock. I mean, they might not have liquid derivatives. There could be other reasons why, the markets may be tighter in the stock market. There's a couple of different reasons why you'd use stocks. You could be making adjustments to your positions. So lots of different reasons. But stocks, about 20% of buying power. Futures and futures options tend to be, for me, around 20% of buying power. Now, when I say futures and futures options, it's because I'm relatively indifferent to futures and or futures options. I would say for the most part, a lot of our positions are futures options, but we do a bunch of, like, for example, pairs trading, which is just one future, two highly correlated futures, one long and one short, or two highly correlated futures that offset each other, and you're betting on either a contraction or an additional divergence from where it's currently trading. So futures and futures options, about 20% of buying power. Now remember, futures are also more leveraged than stocks, and they're more leveraged than options, so that 20% is a very understated number. Options, about 50%. We say options, that's a combination of ETF options, of listed equity options, and of index options. And that the combination of those different option markets changes, or different option positions changes based on what's happening in the market. For example, right now, with the stock market at record highs, the index volume, other than on the zeros, the index volumes dropped down a little bit, and the equity volumes picked up a little bit for most people with positions, because equity options have generally higher volatility right now than the index option positions. But that can rotate and fluctuate based on how the markets move. And then we always keep a certain amount of cash. Now, when we talk about cash, we're going to invest probably much less than 90%, but cash maybe in the 10% range. These are kind of generalized allocations. But just to give you an idea of where we start and what our thinking is, we're thinking 20% stocks, 20% futures and futures options, and 20% listed option strategies. These are not just long options or just short options. These are strategies, some defined risk, some undefined risk, and then obviously a cash position on top of that. So The next thing we think about is, well, we put all these positions together. What does it mean? And how do we watch it? How do we monitor it? How do we know we have on? Okay. We understand through buying power exactly how much capital we're using. So through buying power, we can also learn to measure risk. It's one of the skill sets you develop as you become an active trader and as you get, deeper into kind of what we call kind of more of like active management. But what's most important is really understanding, what do you have on? And so how do you figure that out? Well, first of all, we default everything to what we call beta weighted deltas, which means that we essentially take our position, and in order to compare, an IBM position to an NVIDIA position, to a soybean position, to a bond position, to an S&P position, we have to convert everything. So we can generally convert everything into SPY deltas. That's what we call beta weighted deltas. That's just essentially taking the beta weighting of each underlying, converting it to SPY so that everything is apples to apples. That generally simplifies everything. In 2024, almost every platform has beta weighted deltas. We first introduced this in 2001. And since then, every platform has picked this up. And that's a great thing. You need to have that. Understanding how non-correlated underlyings are defined is important. So what we put here is a list on the right-hand side of the page. And what you can see first at the top is ES. Those are the S&P 500 futures. Everything is beta weighted towards the SPY, and the SPY is the same thing as ES. We'll talk about the measurements later, but for argument's sake, over beta weighting, if you're beta weighted to the SPY, you're beta weighted to the ES. And you can see right below that is the NASDAQ future, right below that RTY is the Russell future, and then we start to talk about things that are not correlated. So bonds are not correlated to stocks. The first three at the top are stocks. The next one, bonds, gold, crude oil, and natural gas, none of those are all wrapped around zero. Any correlation below 0.5 is essentially what we would call close enough to being not correlated. Wrapped around zero has no correlation. So that what that means is if the stock market goes up, it doesn't mean bonds are going up or down. If the stock market goes up, it doesn't mean gold is going up or down. If gold goes up or down, it doesn't mean that crude oil is going to do something. So by doing this, essentially what you've done, and the last one on there, which is the euro, 6E, which is the euro, is another underlying that we feel is not correlated. Now, why is this important? Because it does two crazy things to a portfolio. And we're not talking about having just S&Ps, NASDAQ, Russell, or any of those things on. There's lots of ETF equivalents, like the ETF equivalent to NASDAQ futures are the Qs. The ETF equivalent to RTY is IWM. The ETF equivalent to ZB is TLT. The ETF equivalent to GC is GLD. The ETF equivalent to NG is UNG. And you can find different ones for currencies, but they're not as effective, but this one will be FXE. What's important about this from a discussion standpoint for portfolio reasons is if you have a portfolio that is not correlated, you are going to have a huge reduction in portfolio volatility. It actually comes out to about 35%. So you're going to have a 35% across the board reduction in portfolio volatility. That's the swings that you take. So if you're uncomfortable with a $100 swing or a $1,000 swing or a $10,000 swing, based on the size of your portfolio and based on the type of positions you have on, the way to reduce that by 35%, which is very significant, is to have a portfolio that's where the underlyings are not correlated. How do you do that? Well, you introduce futures and futures options side by side with stock and stock options. Again, this is a discussion about product indifference. We're agnostic to what we trade. We're just looking for opportunity. But not only does it reduce portfolio volatility, it also reduces outlier risk. So an outlier risk is the stuff you can't control. So what happens is, do you still have outlier risk? Of course, there's still. But what it does is it reduces over 90% of your outlier risk. Now, I know that sounds crazy, but you're thinking, how do you reduce 90% of outlier risk? Well, by having a portfolio of truly non-correlated underlyings, what you end up doing based on capital allocation is you end up staying smaller. And by staying smaller, you essentially reduce about 90% of your outlier risk. So we're only 2 slides in, and already what we've discussed is creating a diversified portfolio using lots of different underlyings. And in the process of that, reducing the portfolio volatility, that's your intraday swings and your overnight swings, and then virtually eliminating most of the outlier risk because you've reduced the size of your positions and you've diversified your portfolio. Now I'm going to keep going I'm going to pick up the pace a little bit here. So I just want you to be kind of, hang in there with me, because I get that this gets a little heavy, and if you're new, if you've been around us, have been around Tasty for a while, some of this will be, hey, piece of cake, I got this. But if you're completely new to this and this is your first time, I know it's a little heavy. And again, you can email me, tom@tastylive.com, or you can study this or come to one of the live events. I strongly urge you to sign up for the live events. They will all be full. They will all be basically full and sold out before we do them. But if you sign up early, there's tons of room right now. Okay, we just listed them. Correlation. So we're going to stay on this topic for a second. By including non-correlated assets into your portfolio, the total volatility portfolio will be closer to the lowest volatility asset, even though those assets are equally weighted. See, that's really cool. That's that 30% reduction. So what ends up happening, and you can kind of see, we put the volatility reducing numbers and how much we have basically, plus or minus what happens. Like when you look at the daily volatility of the S&Ps, let's just say it's plus or minus 1% or plus or minus 1.2%, and a bond portfolio is plus or minus 0.7. Well, when you put those together, okay, and you do 50 half and half, you drop the whole portfolio volatility down to 0.72. And that is the beauty of, and just think, that's just two underlyings. That's just breaking it apart. And most people are like, well, I don't want to have, I'll give you some examples. I don't want to put Bitcoin. I don't want to put ETH into my portfolio. I don't want to put digital assets in there. I don't want to do this, that, because the volatility is too high. It is too high in some cases as a standalone, but it's not too high when you diversify your portfolio. And that way you might, on the one hand, have something with a really low implied volatility like the euro at 7 or 8% volatility, and then you'll have a 45 to 55% volatility like Bitcoin, or you'll have a 45% volatility like Nvidia, and a much smaller one like a 25% volatility like Apple. Once you start doing that, or using one of the ETFs, like you might use the S&Ps or IWM, and then all of a sudden you have a low volatility there, and you combine that with a higher volatility, something like natural gas, and all of a sudden you are in a portfolio where you've reduced the volatility down to the lowest common denominator. And that's super cool. And that really helps to again, reduce your outlier risk and to reduce your intraday swings. So the next thing we're going to talk about, we're going to really focus on dissecting the optimal decay curve. So I'm a premium seller, which means I like to sell options more than I like to buy options, or I like to sell spreads more than I like to buy spreads. You can do it either way. Everything is fairly priced. In the world of options, whether they're future options or whether they're listed equity options, the whole world of options is, as long as you're trading a liquid product, everything is priced to perfection. There's no edge. There's no edge. There's no theoretical edge in buying or selling something. There's no theoretical edge in buying or selling a listed option. There's no theoretical edge in buying or selling a futures option. They're all priced to perfection. So what do? You stay in liquid underlyings. You make sure they're diversified, but you live in what we call, there's no theoretical edge, but we believe there's a mechanical, you can optimize the mechanics. So how do you optimize the mechanics? Well, you stay in the optimal point in the decay curve. So I'm going to explain now the advantages of, for example, managing a portfolio early, which again, we're going to get into great detail in the next webinar. But managing a portfolio early reduces the volatility, and it also reduces outlier risk. So you're starting to get the hang of what we're trying to do here, which is when we build a portfolio, we want to reduce the volatility of that portfolio because we know, hey, listen, this is an active trading portfolio. This is not a passive set it and forget it. This is not, hey, wake up in 20 years and see how we did. This is an active trading portfolio where you get to it, you're on it every single day, or as much as you can be, or multiple times a day. And again, you're reducing outlier risk. Also, we can show you that by adding duration, going, longer than, let's say, 20 days, longer than 30 days, longer than 40 days, or potentially longer than 50 or 60 days, you can increase optionality and provide more time to be right. We're usually always all right. We're all right eventually. It's just the timing sucks. Our timing isn't that good. Nobody's timing is that good when it comes to markets. It's really hard. So a lot of times buying duration, being able to extend duration, does two things. It gives you more time to be right, and it also synthetically increases the volatility of the underlying. So it means on a low volatility underlying, you actually create a little more premium for yourself. Also, different durations allow for different strategic opportunities and, again, provide more diversification to the portfolio. You can diversify by underlying, but you can also diversify by strategy. You can also diversify by implied volatility. You can also diversify by duration. So what I have here is a slide that shows this is 45 days to expiration. You can see where it says 45 DTE, that's 45 days to expiration, and then you can see expiration. And what we've done here is we've put an average running P&L placed 45 days to expiration. Now, what most people don't realize, when I talked about, I want you to be at the optimal point in the decay curve, well, 75% of the money you're going to make when you trade is in that optimal point in the decay curve from the first 24 days. The last 21 days, you make 1/4 of the money, even though it has the fastest rate of decay. In the first 24 days, with the slowest rate of decay, it's actually called the optimal point in the decay curve because that's where you make the most money. Most people think it's the other way around. That's what's so fascinating about this slide. And this slide, the first time people see it, they're like, wow, that kind of freaks me out. But it freaked me out because I was doing it wrong for about 20 years. So how do we calculate expected move? Because what is volatility? Volatility, and we base a lot of stuff that we do on volatility. But what is volatility? So volatility is essentially, it's another word for expected move. Volatility tells us and measures how much is this underlying going to move based on the efficient markets that we're looking at. Essentially, it's the cleanest calculation we have as the best guesstimate, as the best approximation for what's about to happen. Basically, everything that is known about that underlying is built into that expected move number. So why is knowing the expected move so important? Because if you know what the expected move is, you have context around where to set up your short strikes and where to set up your an expectation for getting out of that position. Like let's say you bought a stock XYZ and you bought it for $100 and you're like, where should I sell this stock? And you have no idea, right? Because how would you know? But if you know what the expected move is for the next 45 days, and let's say the expected move is $11, now all of a sudden you have a reasonable number because 68% of the time that is the number that's going to be hit. So all of a sudden now you have context around where is a good exit place, or where's a good exit point. And the other side to that is you also know, let's say you want to buy stock and sell a call there. Or let's say you wanted to get short a naked put in order to get long stock for your portfolio. These are all strategies that we're going to cover in the next webinar. But let's say you want to do that. Knowing the expected move is the most important thing you can do. That's why we focus everything on Tasty around expected move. Is the delta of an option an accurate measure of expected move? And the answer is, of course. It's as close as we can get without actually just breaking down the math behind it. So can you use back of the envelope delta as an approximate measure of expected move? And the answer is sure. How do professionals use expected move? And how do professionals use delta? And the answer is they're interchangeable. They essentially use delta as expected move and expected move as delta. And if you think, hey, you know what, that's kind of crazy. That's all we ever did. To figure out what are the chances of this trade working, it was always, well, what's the delta? And that's the beauty of understanding expected move. It's not that complicated. This is a nuanced know-how industry, meaning there's the challenge. Everybody that's on this chat, there's, over 700 people on this chat. I think there's going to be like 5,000 or 10,000 that listen to it probably within a week or so. The 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 beauty of this stuff is that every single person participating today is crazy smart. But a lot of this stuff has to do with nuanced know-how. There's a lot of little nuances about finance in the futures world, in the futures options world, in the listed equity world, in the listed option world, in the index ETF world. That's what I'm trying to get across. This is what we call optimizing the mechanics and optimizing the nuanced know-how. That's how professionals use expected move. It's interchangeable with delta. What does that mean? That gives you a reasonable expectation. It gives you context. It gives you probability of profit. So on the Tasty platform, and I can't speak for other platforms, but we have built other platforms, we will show expected move, and it's right in parentheses. So for example, this is the SPX. And for the zeros, the ones, the twos, and the 5 days, you can see what the expected move is here. That's all it is. It's that crazy simple. Most platforms just list it. There's not even anything you have to figure out. If you need to figure something out, I mean, generally you can use if you have a volatility index that's around, let's just say 19%, the expected move is about 1% for that day. And it's interchangeable among commodities, commodity options, equity options, everything else. Completely, it's all interchangeable. So I'm going to proceed now to capital efficiency across product classes. Now, again, you can see I'm going fast. I have to go fast. I built so much content to this day. I don't even know if we're going to get to it by the end of the next 25 minutes. So I really got to power through it. But there are 3 people on answering questions. Nothing is off limits. And if you have any questions later on after this event, you can email me again at tom@tastylive.com. And that's if you came on late. And again, this event will be available to you in 1 week on tastylive.com/events. Scroll to the bottom of the page and you'll be able to find the archives of this event and the next we're going to do and all the live events that we're doing all over the country and in London. But please sign up early, because they get packed. Okay, capital efficiency of all product classes. Just hold on 1 second, let me see. Perfect. So we are going to compare apples to apples here, like I talked about earlier. That's the beauty of beta weighting, but it's also the beauty of buying power reduction. Now, here's trading in 2024 is very different than it was trading 20, 30, 40 years ago. Everything is based on available capital and buying power reduction. And everything on today's modern platforms, modern technology, which is amazing, is all done on the back end. So you don't have to worry about different regulatory bodies. You don't have to worry about different margining systems. You don't have to worry about any of that stuff. What's important to know is that if you have a regular margin account, everything we're discussing today is a regular margin account. Some people have portfolio margin, reduce everything by a third. Some people have, if you're just trading, for example, futures or futures options, you're going to use about a third less capital, but I strongly recommend using everything. And if you're just trading equities or equity options, I strongly recommend including futures. If you're at a brokerage firm that doesn't support all this stuff, change your firm, because you should have an opportunity. Like, you want to walk into a casino, you don't want them to tell you you can't play blackjack or you can't play craps. That's ridiculous. Everything is the same. Everything is theoretically perfect. And, you should have the advantages of the best product choices and the best buying power reduction and capital efficiency. So we're going to work on the nuances and importance of a capital efficient strategy, because the best way to reduce risk in the world of active trading is to reduce your size, to manage early, and to do as many types of diversification as possible. Also, I'm going to talk about the impact of static and dynamic hedging. Static hedging, just so you understand the terminology, is if I use stock or futures against an option position. Dynamic hedging is if I used options against an option position. And how dynamic hedging and static hedging are different with respect to adjustments and buying power. For example, if I have an option position on and I use stock, it's going to be expensive to use stock. If I have an option position on and I use futures, it's going to be about 6 times. I'm going to get 6 times more leverage using futures than I would using stock. But stock may be more of a perfect hedge than the futures. So you have to make that determination. Do I want to use 1/6 the amount of capital, or do I want the perfect hedge? And then when you're adjusting options with options, you might find, hey, I can do this without putting up any additional capital. That's a dynamic hedge. So there's all those different choices, and you have to be able to make them, but make them instantaneously. The whole key here is speed, not because you're competing with anybody, but just because you don't want to overthink this stuff. You want your brain to process this and to know what your next move is before like you even open up a quote screen. You're going to know exactly what you want to do. My goal here is to get you to think like a couple of steps ahead so that you know what you're going to do to adjust a bad position. And a good position is easy. A bad position is hard. And so when something starts to go against you, I want you to know the most efficient and capital effective way to adjust that position and to give you the best chance to turn it around, bring it back to even, turn it to profitability, whatever it is. So the last thing we're going to focus on here is capital efficiency and the law of large numbers. You know, if you do something one time, it's really random what the results are going to be. So in order for this whole process today and everything we're discussing to be successful, you have got to do this a lot. Meaning we're just playing the game of law of large numbers. I'm going to show you some statistics in a second. But if you do something once, twice, or 10 times, you know what? It's really just very random whether it works or not. If you do something consistent and you're mechanical about it, law of large numbers takes over. And whether you want it to work, you don't want it to work, it's going to work basically just the same way as the probabilities suggest it will. So now we start getting into some kind of, and I promise you, this is not too heavy. It's just new for some people. So just bear with me and there'll be plenty of time to go over this. And again, that's why we do the live show. That's why we spend 3 hours on just part of this content. The importance of leverage the importance of leverage and derivatives in a modern portfolio is basically to give you the ability for an outsized return using less capital. Now, why do I want an outsized return using less capital? And the answer is because if you are going to manage your portfolio yourself and you are going to put the time and resources into active management, you have got to at least have an opportunity to make some multiple of a risk-free return. If risk-free returns right now, or let's just say, is 5%, then there's no way you want to manage an active portfolio with the objective of making 7 or 8%. You're going to manage an active portfolio with the objective of making 2, 3, 4, 5, 6 times what you would make on a risk-free portfolio. That's up to you. Some people are happy with 2x, some people are happy with 3x, some people are happy with 6x. That's on you. But from my position here is I want to show you that option or that optionality is available to you. So what we did on the right-hand side of the page is we talked about a theoretical example for a stock trading at $100. And just so you can look at 100 shares of a stock trading, $100 is $10,000 in capital required if you just did that without margin. So you can borrow up to 50%. But the POP, which is the probability of profit, is 50-50. So then you go buy a long call, which is in this case on the same $100 stock. And you're buying the 30 days to expiration, the 50 delta long call. It's costing you $360, but your POP is only 35% to get over your break even. But your cap reduction is 96%. Is that a good trade? I don't know. But in the last trade on the bottom, which is the 30-day expiration, the 50 delta short put, all of a sudden I've taken my probability of profit from 35 to 65. It's the inverse. My buying power went up to 2,300, which is still 75% less than the stock, but my probability of profit but my cap reduction is 77%. So my POP is 65%, my cap reduction is 77%, and my buying power, which is the reduction, is only $2,300. Now, again, to each their own. I understand that the long call has limited risk, and the short put has unlimited risk below whatever credit you receive, but it's still less risk than the 100 shares of stock, and it has a 15% more higher probability of profit, and it has a 77% capital reduction. This is really basic stuff. We get heavier. So then we go and we start to talk about improving your basis. So this is the key to active trading, to building active trading portfolio. It's all about basis reduction. What does basis reduction mean? Basis reduction means if I have this iPhone here, which hopefully you can see, but if I have an iPhone and this iPhone costs $1,000, how do I buy it for $800? Okay, that's what we call basis reduction. How do I reduce the cost basis of that iPhone by a certain amount of money? So, and then you have to talk about the trade-off between your probability of profit, your potentially lower profits, and how do you deal with that? So the first thing is we talked about, hey, here's a $100 stock, right? And the capital required for that is $10,000. The P&L after it rallies to 105 is $500. You make 5 points, it's $500. If you bought the long call for $363 and we close there, 30 days from now, you make $137. So your return on capital is 38% compared to 5% on 100 shares of stock. But on the short put, okay, using less buying power on a rally, you're going to make $322, which is a 14% return on capital, but you make almost 3 times or 2.5 times as much money as you make on the long call and almost as much money as you make on the stock, but your return on capital is 3x. I'm focused not so much on return on capital, but I'm focused on getting people to understand how important reducing basis is. Because remember, on that short put, you have a 65% probability of profit compared to the long stock, which has a 50% probability of profit. And also that 105 number came from the expected move. So that's all about the expected move. It's really fascinating when you start to put all this stuff together in your portfolio construction. So I'm covering here improving POP, improving your probability of profit. How do you improve probability of profit without adding more capital? You can roll the position, you can recenter the position. Are delta and POP interchangeable? Well, sometimes delta and POP are exactly the same. Sometimes they're generally interchangeable, but sometimes they're, we can create some different situations and learn how to raise your total portfolio probability of profit. One of the things that we want to focus on today's discussion is I want people to understand that you should not be in a portfolio that has a 50-50 probability of profit. You should be in a portfolio where your probability of profit is much closer on the whole portfolio between 65, 67, or 72%. I want you to be in that 65 to 72% probability of profit range. So here's a fun little slide I put together for you guys today. You can see when your delta is lower, your POP is going to be higher. Meaning if you sell a 22 delta call or a 22 delta put, whatever it is, or an iron condor or a call spread or put spread at the lower delta, you're going to have a much higher probability of profit, but your returns are going to be lower. So anybody can generate a 95 or 98% chance of profit on anything, but you don't necessarily want to do that because you want to have a very fair trade-off between your max return as a percentage of your buying power. So where is the perfect number? Is it a 22 delta? Is it a 27 delta? Is it a 33 delta? So that's a decision you have to make. But the nice thing about this slide is it gives you some context around how you make that decision. So again, I'm going to keep pushing forward here. And I know I packed a lot into this webinar, but I don't it's important to me. I never want to waste anybody's time. I know how valuable time is. I know how valuable resources is. So I will never dumb anything down, and I will push as much stuff as I can into a presentation. And then later on, we can dissect it. Later on, we'll do it live. We will break this stuff apart if it takes hours, days, months, whatever. So total capital used as a percent of account value. This is I'm going to put 2 or 3 stars on this page because this is one of the most difficult things for individual investors. How do you learn sensible capital allocations based on various volatility levels? Do you know the number one cause of traders blowing out, the number one cause of bad trading? Number one, there's nothing else even close to it. One thing stands out head and shoulders above everything else. It's size. It's the wrong capital allocation. You can get away with a lot of other mistakes. You can get away with some bad diversification. You can get away with sometimes not being there, not having enough, not being too highly correlated. You can get away with, maybe using too many of the same strategies. You can get away with a couple different things. You can get away with not optimizing your mechanics, but you can never escape the wrong sizing. That is it. Once you get too big, size kills. We like to say when genius fails, it's always about size. So, how to use different product strategies and correlations to assist in capital allocation, and does account size and investment objectives play a role? And you bet they do. So this is an old slide. This is the most conservative case we've ever put together. If the VIX is between 10 and 15 like it is now, the total portfolio buying power uses as a percent of net liq would be very low. In the most conservative case, 25%. In the moderate case, 35%. In the aggressive case, 45 to 50%. And let's just say this is between $50,000 and $100,000 account. If it's $1 million account, it's a little lower. If it's a $10,000 account, it's a little higher. But this is the most conservative case. So VIX at 40 plus. On an average size account of, let's call it 50,000, 50%. On the moderate case, 65%. On the aggressive case, 75 to 80% with the VIX over 40, which only happens five times every 2 or 3 decades. But we easily can see VIX between 15 and 30 for almost 30% of the time. And in that case, we're talking about 32, 47, 60 in those ranges. Okay? So that's the capital allocation based on where the VIX is. It's a very simple way to do it. But let's talk trade size, because this is what freaks people out. Most people, they start out trading too big. Believe me, I wish the problem was people traded too small. First of all, on your platform, always set your default size to the smallest possible number for you. So if your average trade size is 10 contracts, set it to 5. If your average future size is 5 contracts or 2 contracts, set it to 1, and then adjust upwards. So percentage allocation on a per trade and per underlying basis. So what we're doing now is we're talking about trade size versus buying power. It's always about units. The fewer units you can be long or short, and the more credits you can create for yourself is always best. So you always default to fewer units, not necessarily less risk. We default to more risk, fewer units. That's our kind of the way we look at things. So if you want to, and there's one typo here, for defined risk, I take it back, it's not a typo. For defined risk, the position could be as small as 0.3 or 0.5, but we would never allocate more than 5% to a defined risk trade. For an undefined risk trade, the lowest on a big account could be like, a little less than 1%, and the highest on a small account could be about 15%. But we never like to see it be more than 10 to 15% in a single underlying and on undefined risk. And we never like to see it be more than, let's call it 0.5% to 3%, maybe max on a small account, 5% of defined risk. You have to be very careful. Like you don't want to do, 50 spreads for, let's just say 50 cents versus 2 contracts for $5. Like you just don't want those extra units. So you'd rather take the more risk and the fewer units. So you have to learn that. That is one of the challenges. That's one of the nuances of trading. And then you also have to learn between listed options and futures options, because futures options under span margining give you more leverage and much more flexibility. And again, I'm going to use this word for the third time, more optionality. Futures options are the most cost effective in the world because you don't even have to put up full risk. But over time, the capital requirements change on futures options, which is something you're not used to on listed options. Either way, you have to learn to adjust. For futures and futures options, you're going to be about 1/3 less than for listed equity options. But these numbers here of the 0.5% to, let's call it 3% for defined risk, max case 5, and for undefined risk, anywhere from 1% to 3 to 7%, max case 15, depending on the size of the account. Just keep your allocations small, keep your contract size small, increase your risk, reduce your contract size. Always think about that. So in addition to that, another takeaway from earlier is manage early, stay small. And it flows right into this. Manage early, stay small, manage early, and keep your capital allocation small. Keep your contract size small. It's the most effective way to manage risk. People use stop orders and think that that's managing risk. That is essentially just as bad as allocating too much capital to a trade. You are far, far better off keeping your size small and managing risk that way. So let's talk about using buying power as a measure of risk. A lot of people will look at risk graphs. They'll look at kind of worst case. They'll look at deltas. One of the really effective tools, back of the envelope tools for managing risk, is to use buying power reduction. If you use buying power reduction on a trade, essentially, we own a brokerage firm, and the brokerage firm uses buying power reduction as an effective tool for measuring risk. And we have customers with, millions of positions on. On an individual basis, back of the envelope, if you want to compare apples to apples, use buying power reduction as a very effective tool for managing risk. It's a cheat sheet way of doing it, but it works. And it's actually perfect. And it's the same way that professionals operate. Professional traders, not floor traders. And the reason for that is because buying power reduction is an effective tool for measuring risk, and it allows you to compare product A to product B to product C to product D to product E. Okay? Having a bunch of positions on is not a bad thing. Having small diversified positions is really a good thing. So the short put or call buying power is, and we just put the formula down here. I don't have to read it off to you, but that's how you figure it out. The back of the envelope way to figure out buying power on a short call or short put is just essentially say it's a little less than 20% of wherever the strike is. That's the simplest way to do it. So you have to figure it out. And on the future side, most cases, it will be anywhere from a quarter of that number. It's around a quarter of that number. It could be a quarter to, let's just say a quarter. Keep it simple. So then it comes down to, okay, well, I've created these positions, Tom, but what is my portfolio probability of profit? Some platforms show it, we show it, some platforms don't, whatever. But what is the portfolio and how reliable is that? Do I have to figure it out manually? Is it on the platform? Whatever. The answer is it's pretty damn good. But again, it relies on law of large numbers. Your portfolio pop it is very dependent on law of large numbers, meaning that if you do something on a very random basis, your results are going to be very random. If you do something on a very mechanical basis, your results are going to come very close to whatever your expectations are. Is there an optimal target for probability of profit to aim for on a total portfolio? And like I told you before, yes, 65 to 72%. How many occurrences or trades do you need to predict your portfolio's pop accurately for law of large numbers to kick in? And this is an interesting question. And again, this is for today's audience only because you are active traders. You're listening to me, on a Wednesday midday. This is what we do. This is our own small little crazy world. I get this. We're all junkies. And so the answer is we're trading junkies. And the answer here is that I would say, and I'm going to probably, I don't want to scare the children, minimum of 2 trades a day. That comes out to about 500 or 600 trades a year. I would say average is somewhere in the neighborhood of 1,000 to 1,500, and I would say that average could easily be 5,000 or 10,000 if you wanted to. I wouldn't blink an eye at it. But at a minimum, about 500 to 600, which is 250 trading days. It's 2 trades a day. It's just adjustments. That's not 2 opening trades. That could be 1 closing trade, 1 adjustment. You might not make an opening trade for 5 days. It's just adjustments. But on average, it's higher than that. The average tasty trader, it's about 1,200 trades a year, that kind of thing. Let's go to next slide. And here's what's kind of important about this. You can see here how the numbers smooth out towards whatever the expectation is. If you only make 10 trades, you know what? Your win rate looks pretty damn good at 70%. Your standard deviation, which is the amount of fluctuation, looks pretty damn good. But you don't know what that is. But it's still a very random number. And the P&L per trade, wow, that's huge. So it worked out in this case because it's random. But if you go down to kind of all trades, which is a true mean, or 1,000 trades, you'll see that your standard deviation goes way down and your win rate goes way up. And so the more times you do something, it's not that you get better at it. It's just you take out those random outliers and everything gets flattened around the curve. And that's what you want. In order to be successful, what do you have to do to be a successful trader? You have to learn to scale and make things repeatable. And in order to do that, or in order for that to happen, you have to do things a lot of times. And that's essentially what we're saying here. Now, I'm a few minutes over, so I apologize. I started a couple of minutes late. And again, I've never done this particular webinar before, so I'm going to go a few minutes over by about 5 minutes. So just bear with me. Please hang in there because this is good stuff too. And again, I started a couple of minutes late. I'm trying to be on time. But this is my first time and I packed too much information in this one today, but nobody ever, it's free and nobody ever complained about getting too much. So here we go. Last part, building a directional case. This is about opportunity because there's lots of different ways to look at market direction. Sometimes we are all non-directional, and non-directional or delta neutral is a directional play. So that's, I mean, as simply as I could say it, delta neutrality is considered a directional play. Is price capitulation measurable and is it accurate? Well, it's not measurable, it's subjective. Is it accurate? No, it's a contrarian play. But is it something that a lot of us use? Of course. We assume price capitulation, we think markets have topped out. We assume price capitulation, we think markets have bottomed out. Is there anything wrong with that? Of course not. Can volatility predict future price? And the answer is no. All volatility can predict is future contraction or expansion because volatility has mean reverting qualities. Can option pricing skew be used to help pick market direction? This is what tons of people ask us. If the puts are more expensive than the calls, are we going down? If the calls are more expensive than the puts, are we going up? No. It cannot be used to pick market direction. Pricing skew is used really to show you where the market perceives the velocity of risk to be. It has nothing to do with market direction. That is a very popular misconception. So how accurate are those beta-weighted deltas that we talked about to start this discussion? And the answer is as good as anything in this entire world. In other words, as good as any measure can be of anything, this is the largest marketplace. It's better than a line on the Super Bowl. It's better than any bet you're ever going to make as far as accuracy, because there is way more money here. Do liquidity and correlation impact the beta-weighted accuracy? And of course they do. The more liquid the underlying is, the more efficient the markets are, and the better your numbers are going to be. Does correlation impact it? Of course it does. Because again, if you want the most accurate situation, you want the most liquid underlyings. And liquidity leads to efficiency, leads to accuracy. Is it best to hedge beta-weighted deltas with indexes or individual stocks or futures? Let's be fair here. Should I use futures? Should I use an index? Should I use an individual stock? That is 100% up to you. If I'm trading crude oil and I'm trading crude oil options, I like to use other crude oil options to hedge it. If I'm trading NVIDIA, I like to use NVIDIA options to hedge my NVIDIA position. If I'm buying or selling, let's just say as an example, I'm long the Japanese yen and I want to hedge that position, I will sell a Japanese yen call against it. If I have a big position of options beta weighted to the SPY and I find myself, let's just say, short 2,000 deltas and I want to reduce my risk by 1,000 deltas, I will use S&P futures or I will use SPYs. It doesn't matter. I'm indifferent to those. I'll sell if I'm long 1,000, or I'm sorry, if I'm short 2,000 deltas, I'll buy 2 S&P futures, ES futures, or I'll buy 1,000 shares of stock, or I'll use, let's just say I'll use a couple of at the money SPY calls or long SPY calls or short SPY puts. So I am indifferent to what those hedges are. I tend to use dynamic hedges. I tend to use the individual underlying, but sometimes we use futures, sometimes we use indexes, and it's really up to the individual. Just know that all those choices are available to you. So again, if you're new to all this stuff, we're talking delta, we're talking theta, we're talking all this kind of crazy stuff, and which is, I put the definition of delta on the right-hand side here. It's the change in an options price given a $1 increase in the underlying price, and theta is the sensitivity of an options price to changes in time. Speed, the amount of premium that you're collecting. Gamma is the speed at which it happens. But in order of importance, which contributes more to your P&L, delta or theta? Well, I hope it's theta. Sometimes it could be delta. If you're delta neutral, it's theta. If you're directional, if you're delta neutral, it's theta. If you're directional, it's delta. What are reasonable guidelines for portfolio theta? Well, you've got to be careful here because you do not want to be too big. Remember, that's when genius fails. So reasonable guidelines for portfolio theta are to stay small. Usually, my number is 1/10 to 0.3% based on your net lick. Again, I'll repeat that. What's a reasonable guideline for daily theta? 1/10 to 0.3 of your net lick. And everything we talk about today is based off net lick, even buying power reduction. And is it possible to manage delta risk based on notional equivalency? And the answer is, of course, it's possible. It's just not that efficient today. You're better off managing your delta risk essentially against your net lick or against your theta numbers. Notional equivalency gets to be a little complicated. And measuring risk through beta weighting. Okay, so I just did this. Let me just go through this. Here it is. Is there such a thing as a product expert anymore? And the answer is no. I mean, there's experts in the industry, of course, that can talk about, different macro things and can give you second derivative Greeks and all that kind of stuff. But there's no such thing as I'm a futures trader. I'm a stock trader. I'm an option trader. You're an everything trader. Markets are markets. This is an auction marketplace. It's an efficient marketplace. Okay. It's a true frontier of capitalism. It works. Okay. You have to trust that theoretical pricing and efficient markets actually work. Is strategy diversification just as important as product diversification? And the answer is it absolutely is. And liquidity is as important to product indifference. Liquidity and product indifference are as important to all this stuff as anything else. As far as account type and account size, they do play a role. You have to have a margin account. Obviously, it's impossible to do this stuff in a cash account. Can you do this stuff in an IRA account? Yes. Is it a little harder? Sure. Can you pay somebody else to do this for you? The answer is no, not really. And does account size play a role? Of course. I mean, the larger account you have, the more flexibility you have, the more different things you can trade. But it is what it is. Like, different people have different amounts of money, and we respect that. And if you're at a different point in your life, if I was doing this 30 years ago, I would be at a different point in my life than I am today. So, of course, all that stuff plays a role.